That is the late, great Vern Gosden, born about 15 miles from where I'm at right now in Woodland, Alabama. That's the thing that he and Beth Colson Gaines has in common. Beth and Vern Gosden from the same place, Woodland, Alabama. Or around here, what we call him, we don't even call him Vern, we call him the voice. Wow. What a voice, right? I mean, really, really, really good. We need to play more Vern Gosden. Just can't get enough Vern Gosden. God rest his soul. Hey, y'all. How you doing? Welcome into the Trading Nerd community. Fun week. This week, we are going to meet in Atlanta. If you hadn't signed up yet, let Ed know. We might get some more people in. We're going to go see Sosnoff at Oglethorpe University on Thursday evening. We will be trading together on Friday. I have invited Tom Shosnoff to join us on Friday. He said, depending on how far away he is from where we're staying, he may just pop in with us, which would be really cool, just to sit around and chew the fat with Tom. And then we'll see the Tasty Gang on Saturday at the Bad Trader Tour. So this is going to be a fun time. I cannot wait. I got to pick Ed up at the airport. That should be something. Picking him up in my 2011 Nissan Rogue with the chicken nuggets all in the floor. So I know what Beth will say. Oh, you're going to clean your car up for Ed, but you won't clean it up for me when you take me out on Fridays? So I may have to run it through the washer and get the chicken nuggets out of the floor. So we'll see how that goes. And I've got a bag of mealworm feed in there that's been in there for about 2 years I need to throw out. So there are a lot of things I got to do this week to get ready for the conference, the convergence of the Muscadine Mafia. It's gonna be a lot of fun. So we may do this every year. We ain't gonna do it in May though. I'll tell you that. Best done told me, you don't ever plan nothing in May ever again. I'm like, yes, Vic, I'm there. Whatever you say, Vic, I'm there. So look at the market, y'all. Market ain't doing nothing. It is just rough, staying where it's at. VIX is at 17.43. Look at the big green monster, right where it should be. It's right at the point of control. It's fairly priced. So this is kind of saying a little bit bearish to a little bit neutral for the next 10 days. Let's look at the expected move. Yeah, we'll be Zooming Friday. If you can't make it to Atlanta, I'll just turn it on, leave it in there, and y'all be in the conference room with us. That'll be fun, right? And then we'll go to lunch. We may even Zoom from lunch. Wouldn't that be fun? Like Zoom from the lunch table, and that'll be a lot of fun. So yeah, we'll just turn it on, leave it on. So y'all can kind of be there with us, just chewing the fat and having a good time. All right, so let's see. We're at the point of control. I want to look at the expected move. So we are due, y'all, to have an inside week. And an inside week means we are due to have a week that's inside the expected move. You see the expected move, we deviated outside the expected move to the downside last week. The week before, we deviated to the outside on the downside of the expected move. This week's expected move is about 4,200 down to 40.69. We are due to have an inside move, which means not a lot of movement. So we'll see how that goes. A lot of times you'll see outside, inside, outside. It's kind of the way it goes, right? It'll be outside, then inside. Well, that was outside too. We got a lot of outsides. Then we got an inside, outside. So we'll see how it goes. Nothing really to see. Now, the problem with what we're doing is it's kind of boring, y'all. What we're doing right now is kind of boring. We're just kind of printing money. And that can be boring. As I was talking with Ryan today, he's doing some zero DTE stuff to kind of keep his engagement up. But if it's not part of your plan, don't do it. You got to make sure that you've got something outside of trading to scratch that itch of entertainment. We don't do this for entertainment. We do this to print money. And the vast majority of the time, we are printing money. Now, usually it's not as slow as it is now. We just kind of print money, and market kind of just doesn't do a lot. And, volatility is low. But this is where you don't stop trading. You just don't trade too big. So if you're doing zero DTEs and stuff like that, make sure it's in your written trading plan. Maybe have you a separate account that you do that kind of thing in, or you can do it in your main account, but just keep it really, really small. Okay. Only as a tool of engagement. I don't want y'all blowing accounts just because you're bored to death. Making money when you get this down is a process, right? Winning a championship at the University of Alabama is a process. Is that boring? No, you just go in and do the work every day. I'm 25 pounds away from my goal weight. I was talking to my trainer today. We worked out today. She almost killed me. And I go, I don't enjoy this. It's just not fun for me. The sweat, the pain, the agony. But I do it because I know it's part of the process for me to maintain my health and to be around for my family, because it really hit me the other day. I was watching Married at First Sight, and I got all emotional thinking about my 3 daughters. They range in age from 18 to 8 to 6 or 7 now. 18, 8, and 7. And I go, I got to be around for their weddings. So if I'm going to do that, I've got to take care of myself. So if you're going to be financially ready for the future, then you got to not gamble. You've got to have a thorough process of training, and you don't need to deviate from that. And it very well may be a boring thing. Y'all want the expected move chart? Let me share that for you. Absolutely. Nothing we got proprietary. I got that from Don Kaufman, and he shares it with everybody, so I don't think he's going to sue me for doing it. Let's see. The expected move is, it's really cool, right? It's on SPX. I think you can do it on anything, though. But let's see. Expected move. So let me share that. How do I share it? Let's see. Here we go. Share grid. Share, and I'm going to put it into Control V. There you got it. It's in the chat. Okay. If you have any questions on opening that, let me know. So y'all just gotta keep doing the process, y'all. A lot of you will deviate from the process because it's boring. It's just boring. Do the same old thing every day. So let's see how we are doing today. Let's open this up. We're at 37,146. 37,147. All right, 37,147. Let's see how we're doing. 37,147. You sit there and you go, well, over the weekend I made $30. Well, praise the Lord Jesus.
Well, we're moving on now. To the side. To a deluxe apartment in the sky.
We got a little bit of weekend theta burn. That's good. And you say, well, $30, man, I could work at McDonald's and make more than that. Okay, well, get your job at McDonald's. All right, so now let's see. We are at 24.38. 24. Boring is good. 24.38. Oh, yeah, 24.38. So we're still at 0.10. VIX is at 17. We saw that earlier. And our little buying pair is at 92.92. 92 was a great year. I remember it well. 92. Okay. I could put on a trade today. Probably not going to put on a trade. Don't want to push it. My theta is sufficient at 0.1. I'm at 25%. Buying power. Deltas are fine. Yeah, that count looks really, really good. Nothing to do there. So let's close that one up. Now let's go get our little, what we call IRA here. And our little IRA, see if we got any weekend decay here. We are at 84,986. 84,986. 84,986. Oh, yeah. 84,986. The power of weekend theta decay. All right, so our deltas are 97 minus 20 is 77.89. 77.89. All right, let's put that in. 77.89. My pleasure, Glenn. 77.89. Oh, yeah. Look at there, y'all. We made profits and our theta went up. Look, we're at 0.10. VIX is at 17. Nobody try to be a hero today. And our buying power is 26,292. Buying power 26,292. Why did that go up so much? 26,292. Wow, what happened there? Oh, look, 26,292. Went up to 30.94%. I must have typed that in wrong the other day. That looks low anyway, right? Let's look back at that. Our theta or buying power is 26,292. Yeah, that's right. That is right. Oh, I know why. Remember I had the ES position on? And my ES position must have expired. Okay, that's why my buying power went back up. Okay, no big deal. So let's go back and look at these. 77 looks good. We're at 0.10. I mean, there's nothing to do here. I mean, there's just nothing to do. Let's look at our trades over here. Here's our open trades. So all of our debit spreads, look at those debit spreads, y'all. Oh, they're becoming beasts with 11 days to go. We got some nakeds at 39. So nothing at 21 or 28 days, which I normally, take stuff off. So there's nothing to do here. Okay, close it. So I got to figure out, okay, I need to go to the dump and get the mealworm feed out of the back of my trunk so I can get Ed's luggage in there, because God only knows what Ed's bringing with him, right? I mean, who knows what the man's packing? I mean, he ain't even here today. I mean, where is he? Where the crap is the man? So let's see how we're doing in our good little account here. Here's one where we do our best. 5, 8, 23. See if we got a little weekend theta burn. Let's see. Crimson. We are at 35,505. 35,505. Oh, yeah. 35,505. Right? And praise the Lord. Hallelujah.
Well, we're moving on now to the east side, to a deluxe apartment in the sky.
Okay. And over here, we are at 34 minus 8 is what? 26, 39. 26, 39. Oh, yeah. 17 there. James is coming to Atlanta. Trey is coming to Atlanta. Who else is coming to Atlanta with us right here? Anybody else? Ed's coming. Oh, there's Ed. Notional Yoda. I'm used to seeing him as Ed. Who else is coming? It's going to be fun, though. I cannot wait. All right, so our buying power usage is a measly 9,107. 9107. Let's put that in. 9107. Okay. So what Ryan and I were talking about this morning is, what do you do when everything's green? In this situation, do you put on a trade? I would say we would probably not put on a trade. We would wait to get a little bit of a down move before we put something on, right? Let's look at our existing trades. So these are put debit spreads. We got nakeds at 39 days. Yeah. Make sure my auto close signal is right, because I changed that to if it's less than 28 days. Less than 28 days. Yeah. Yes. Less than 28 days. Okay, good. Got everything working right. So my spreadsheet's doing great. Everything looks good. I mean, you can, you sit here and go, if you're ultra conservative, you could say, well, Bobby, look, I'm at 0.11 on my Greeks and ratios. I mean, literally, you could say, okay, man, I'm going to take a little risk off, right? You could go over here and you could say, well, let's see. I got something here that's at 46% profit, made $48, but I'm not going to micromanage it that much. I'm not going to go in and say, oh, yeah, let's take these off. But you could, right? And then what you would do is by taking this off, you lose, 3 theta. But then what you do is you kind of replace that on a big down move where volatility increases. But really, there's just nothing to do. Nothing to do. Our T-bills, look, are just printing money. Our put debit spreads are doing nothing, right? Like they're up to. I kind of like what Ryan's doing. I don't think Ryan would mind me telling y'all what he's doing. Y'all know he's done a lot of back tests and stuff. What Ryan's doing is he said, well, screw the put debit spreads. I'm just going to sell puts. There is nothing wrong with that. And by doing so, he's able to sell less puts and have less notional exposure, less notional. Oh, Carl's going to be there. Awesome. Okay, Kent's going to be there. Okay, good. Look at this. It's going to be fun, y'all. It's going to be fun. I can't wait till we go to Applebee's. I mean, can y'all imagine? I mean, we're going to be at Applebee's. I'm going to get the Fiesta Lime chicken with the mashed potatoes. I don't know how far an Applebee's is from downtown Atlanta. Surely there's one that we could go to, though. We'll find one. And we'll eat in the little Sundial restaurant in the it's going to be fun. Oh, bring your gym shorts. We'll all go to the gym. We're going to work out at the gym, do some exercising and sweating to the oldies. And that'll be fun. So it's going to be a good time. I can't wait. It's going to be fun. What was I talking about? Oh, what Ryan's doing is he's just selling the naked puts now. He says, screw the put debit spread. And the reason that occurred to him is he went over here and he said, look, these things are 100% losers. They really are. It makes us feel good that they're there, but the deltas of your neckage are the deltas of your neckage. He said, I'd just rather, manage those. That's fine. And no problem with that. No problem with that at all. So we're on track for an 18% return, right? We're up 4.13% so far. And compared to the S&P is up 7.3. We're up 4.13. So whereas we have 17 naked puts, Ryan may have 14 naked puts to get the same amount of theta because he's not having those put debit spreads in that are costing, but I prefer to have the put debit spread. I like having a little bit of a bump here, right? Instead of this all being the same and all looking the same a little bit, I like having this thing going up a little bit. That's just me. But what we are, y'all, keep in mind, what we are is put sellers. We are put sellers. Yes. Ed will be there at 1:20 on Thursdays when I got to pop. My God, Ed, that's early. Is that your time or my time? When I got to pick Ed up. Yours. Okay, I got to pick you up at 1:20. Okay. I'll be there, Ed. I'll be there for you, buddy. I just like having this little hump to the downside. I like, instead of it being all the way down like this, I kind of like it going. That's just me. But Ryan says, screw that. I'll just manage it. So what he's doing is he's saying, look, he's selling 6 delta puts. And if the 6 delta becomes 30 delta and VIX is above 35, he's not getting back in. He's just closing it for a loss and sitting out for a while. If it gets to a 30 delta and VIX is less than or equal to 35, he's rolling, right? He's going to roll out in time. So make it your own. Make whatever you're doing your own. Do your thing. But what you got to figure out is what we do is we sell premium, collect theta, right? We collect theta. We manage chaos. We manage chaos and we rinse and repeat. That's all we do. And it doesn't matter if you're James doing iron condors or put credit spreads or call credit spreads, separately or as iron condors. He's selling premium. He's collecting theta. He's managing chaos and he's rinsing and repeat. Just rinse and repeat. Over and over again. And over time, we're going to do really, really well. Now you say, I know what you're saying. Hey, Bobby, you are underperforming the market. Okay, I got it. But most scenarios, I'm going to overperform the market. And I hate going back and saying, well, y'all remember, it wasn't just a month ago. We were up 9-point-something%. We were up 9.48%. Okay, so we went down a little bit. We had Bombageddon. That took us down a little bit, but we're coming back. So we're at 4.13% now. I believe that we will, in most markets, overtake the market. We may not. We'll see. But I think it's safe to say we're going to do well. What we should have done is when you're really overperforming the market, what we should have done, if we look back on the 7th, right? Let's look back on the 6th and the 7th, where we were really up here, right? I mean, we were like, oh man, it's 2 months in and we're on track to do 50% a year. Right here, y'all, we were on track to do 50% a year. So what we could have said, hindsight's 50-50, according to Pat Dye, but what we could have said is, oh man, now is the time when we're really outperforming. Now's the time where you take off risk. Don't keep pushing it. Don't keep pushing toward that 50%. Maybe push for the 30 or 40%. And back on 3.6 and 3.7, we could have said, yeah, this is what we should have done. We should have said, okay, I'm at 0.13. I need to get that down to 0.1. I'm at 0.12. I need to get that 0.1 or even less and take risk off of the table, right? Here's where we closed a lot of positions and got out. But what we could have done is going up into that area is we certainly could have taken off risk. No doubt we could have taken off risk. So, if we get there again and we're doing like 4% a month, and we're 10 months in and we're up 40%, maybe scale back a little bit. Maybe scale back on your theta. And that's one thing that Ed and I were talking about is, no, Ed, you're not going to Uber. I'll get you. Ed. Don't worry about it. We don't want you to get shot by an Uber driver in Atlanta. Now, when we go to Oglethorpe University, I don't know how we all going to do that. I guess we're going to have to Uber over there. I can drive. I can get about 4 or 5. And maybe if you would, why do you want to Uber, Ed? Why are you saying Uber? You don't have to Uber. I got you, Ed. Yeah, I'm just going to charge you for a little bit of gas money for picking you up. And no big deal. Yeah.
I was thinking I'd take you to Applebee's at that time.
Oh my gosh, Ed. Now that would be nice. We'll figure out how close an Applebee's is there. Do we want to overdo Applebee's though? I mean, I could eat Applebee's every meal, but I mean, would we want to overdo
I thought we'd do it then and get Applebee's out the way.
Yeah. Well, what about everybody else, Ed? I mean, that's kind of selfish of you to take Applebee's away from everybody else.
I thought it was generous of me to offer to pay for your Applebee's meal when you owe me an Applebee's meal.
Well, that is true, Ed. That is true. It was mighty nice of you to offer to buy my Applebee's meal. I mean, if you're going to buy, though, Ed, I mean, I may get the appetizer and everything. So don't tell me that till after the check comes. Then you say, because I'll be eating, really cheap. Now, I got you, Ed. Thursday, I got you, Ed. Don't worry. We'll go to the gym. We'll be working out. I'm gonna work, Ed. I'm going to have him sweating. Bring you sweat clothes, Ed.
Yeah, I don't know.
What do you mean you don't know?
I can't work out too much.
Why?
I have a weight loss problem.
Yeah, but Ed, working out is not about weight loss. It's about toning up all that saggy stuff that you got hanging off of you.
Yeah. I'm a fat, skinny person, huh?
Well, we got to do an hour a day, Ed. That's what I do. I'm an hour a day. And look, we'll get it out on Friday morning. Before the market opens, we'll all have our workout done. We'll all have an hour in. Yeah, all that saggy stuff, Morgan. You know what I'm talking about. Notional Ed needs a limo. Oh, I can say, he can say, oh, I'm not riding in Bobby's 2011 Nissan Rogue with mealworm food in it and chicken nuggets. I could see it. Ed's got his standards, y'all. Don't let Ed fool you. Ed's got a sophisticated palate. What were we talking about? Yeah, I got you, Ed. Don't you worry about it. Thursday, I got you.
We're talking about this elevated profit theta situation. So go back to the beginning of March. Let me just, if you don't mind, since we're talking about that. So like you're kind of, so your deltas were elevated in late February and early March. Yet I think you were kind of having spectacular returns in there too, weren't you?
Yes. So 228, let's go to 228.
I'm just trying to figure out what might be a trigger.
Well, wasn't that good? Look, 228 is...
You're entering an interesting area. And of course, I'm trying to get more into the whole, let me just preface by saying I'm trying to get more into the scheduled entry and scheduled exit part of doing And this is more discretionary toning of the portfolio, but I do think it's valid because we've said all along, theta is a measure of risk. And I don't like going too much above 0.1 or even especially 0.5. I don't like busting. To me, that does mean I'm pushing it too much. So with your theta wasn't that really out of whack there. And again, we almost have to go back and do a separate look on what kind of hedging you had going into there and all that business. But I'm trying to imagine what would trigger us, other than your outsized profit based on the market, what would trigger us to make a defensive adjustment? Would it simply be some kind of, we're going to be we're going to ring the register when others are being greedy? You know, I hate to say we're going to be fearful when others are greedy, because I don't think we'd really be fearful, but it would be, you're talking about a proactive adjustment to tamp down our outsized profits. It could just be like, in other words, what would trigger that? Would it be like, I'm up 8% and the market's only up 4%. I'm going to take my risk down and continue forward. So I don't have as much chance of losing some of my outsized gains.
Yes.
Something like that. I'm just trying to imagine what would be going into a rule-based system to trigger us. And clearly your elevated deltas gave you an opportunity to see some of that.
Yeah, I think that this absolutely did, right? I mean, at some point I should have said, wait a minute, there's a reason that my deltas are getting out of whack. I probably should have pruned a little bit here. There's not a lot to prune, but I don't know. I think at some point, though, we do need to look at that. How are we doing in the market? If we're substantially outperforming, maybe now's the time to take off risk, because what we could have done, that would have allowed us to take advantage of the Farmageddon, right?
And the other thing going into that period, again, for lack of a specific trigger, would be like, and it again would entail you doing some trade analysis. Like, what trades were you doing in that late February, early March period? Were you shoving them in with aggressiveness? Was your roll slow? I'm guessing since the market was rallying before it hit that bad spot, you were probably shoving theta into your account and kind of having trouble keeping your theta up. So, let's look.
Well, there wasn't anything. Look at this. This is crazy.
You really didn't trade much there at all. That's the right.
Look at this.
Back in this time, this is when you were putting on a decent amount of trades and your deltas were elevated, so you were shorting a lot of futures.
And
that was part of the issue. Is I think that there was, since you were able to neutralize delta with your futures and your theta was low, you just kept putting more trades on. And every time you shorted futures, it lowered your buying power. And it kind of did to us what the TND did. You had artificially low buying power. Then all of a sudden, once the volatility came in, your account went, whoa, what's going on? Because this was when we were pretty futures heavy.
So I think what I'm hearing you saying is it probably would have been better to say, listen, rather than negating it with futures, I should have closed some of my open nakeds that I probably could have closed at profit, right, to reduce my deltas and just take risk off the table rather than deploying the futures so much.
Or maybe this is a moment where we look and see if we should be including our metrics with a hedge or without. Because if you didn't include your hedge metrics in here, you would have seen your metrics were way further. Like, it's hard for us to look, like Evan's point is awesome. Like, I'm glad he has the memory to remember what was going on then. I sure didn't. But it does give clarity to the fact that if you had been tracking your metrics, or any of us in this situation had been tracking our metrics without the hedge, you would have seen like your metrics were sky high elevated, and taking that into account instead of maybe saying, well, my metrics are okay, I'll put on a couple more positions or two, although it doesn't look like you did during that explosive period for the most part. As elevated as your deltas look there, and they apparently went green from red because you were hedging based on what Evan just said, maybe it's a case to maybe it's a case to do these 14-day hedges and not do futures hedges unless you absolutely have to. And maybe it's a sign when your delta starts popping up without a hedge, you take positions off proactively because your risk is going up, even though you might have to take off. Say, I know your policy is winners and then break evens and then losers. Maybe we would have to get more aggressive with the removal of those trades and not as reliant on the futures hedge as a short-term means of, I don't know. I'm just talking out loud. I really don't know, but I agree with what you're saying. If we could figure out how to temper our enthusiasm for bullishness into a rally so that we could handle pullbacks more effectively, be more efficient at putting on premium, that would be good. I don't know how to do that in a discretionary way. And that's another reason I'm starting to lean toward the timing entry of all this stuff. And I'm working on all that. I'm going to share it when I get it all down. It's not science yet, but a few of us in here are working on those kind of concepts where, and this, as I mentioned a few weeks ago and have mentioned a couple of times since, and this is also a good, it's not only a good entry mechanism, it's a good exit mechanism. So if Ryan's adjusting his 30 delta at 30 delta, adjusted at 30 delta, and that's fine. I have no problem with that. But sorry, I'm getting a text here and it's distracting me. When you adjust, whether it's a roll or a stop, I mean, a roll is a stop and a replacement of the same risk or a fresh new risk. When you do that, oh my God, sorry, everything's pinging like crazy over here. Maybe you go back to your schedule. Like, okay, I rolled today. Normally I'd put on a position today or tomorrow. My metrics say I can do one now. But if your schedule says you're not due for a trade for 3 days or 5 days or 1 day, maybe you don't do that trade. Maybe you look at your schedule and say, I'm going to wait because you just got forced to roll a position, a defense mechanism. Maybe you want to stay in defense mechanism and not put any additional risk on, even if your metrics say you can, because you've already gotten jammed up so bad that you're adjusting positions. Again, I'm just talking on the fly out loud. I don't have any clear answers, but to me, this, again, as I've said before, looks like a clear example of why scheduling your trades could keep us out of trouble. We wouldn't immediately run into more positions in what may be a 10% decline, and we've only had a 7 or 8% decline. And if it's the bottom, it's the bottom. You adjusted and you did what you had to do, and the market recovers. You capture a lot of your theta back, and all is relatively good anyway. But if we don't, and you just keep entering trades by the metrics and not entering trade by the metrics and your schedule, you are putting on additional risk that might blow up right then and there in your face again. And I hope that makes sense. I know it makes sense to some people that understand what I'm talking about, but ultimately, I think what we're fighting with now is how to hedge the portfolio and how to keep ourselves from blowing up further when we're in defense mode. And I think if you don't rush in, any trader doesn't rush into these fresh trades, but follow their preset schedule, they're far more likely to have a smoother experience, it looks like. And again, I don't have all the answers down, but again, and watching all these people that went through in the Volmageddon, like people were like, quite a few people had run away from this and run to strangles. And I was even looking at strangles, and people were getting their head chopped off day after day with strangles. You know, the ES is blowing out. Now gold's blowing out. Now oil's blowing out. And, you know, volatility correlates in a panic. And although gold might have been protecting your overall portfolio if you were just long it against the panic in the market, if you're in a strangle, the gold strangle didn't help you. It just exposed you to more blow up risk. And the same thing when bonds got crazy. So all these strangles are blowing up at the same time, and people were running right back into them like, oh, I got stopped out. I put another one on. 2 days later, oop, I got stopped out again. And it could have been because the market was falling in that commodity and then it rallied and they got stopped out in both directions. It doesn't have to be a same direction stop out. So again, timing, and that's when some of us started talking about timing there. Like if you get blown out of a strangle, maybe you don't put on a strangle right away. Maybe if you're not due to put on another strangle for a number of days or a week or 2 weeks, you wait your period. And that's that. So I'll stop. There's enough ramble from me, but I am doing a little bit of an advertisement for the scheduling of trades going in and continuing it in the face of turmoil.
Tell us about your scheduling, Ed, and what you're kind of doing. What are you leaning toward right now?
What I'm and you know, I've been consulting a lot with Raging Bull on this. I'll just throw his name out there, and he's the one that really kind of brought the scheduling thing to me. He is a student of others. He didn't invent it, but he embraced it and uses it. And basically, what you do is, and I do it per X amount of account. I want to figure out. And I'm doing some 1-1-1s in a light way, and I'm selling a bunch of SPY puts for most of my theta right now. And of course, doing the T-bills. That's the trifecta of my account right now. So basically figure out how many SPY puts do I need to sell and how often to generate a certain amount of return. And that's selling a certain amount of theta and targeting a certain exit point. And when I hit that exit point, I come out. And then I don't put another position on. So I might, like now I have 9 SPY puts on. I think I can go up to 16 in this account. And I have another one where I can go up to 4 in that account. If I get to 16, I basically, I will stop. I'm not going to put on anymore. Some of those should be coming off in a normal market. And if they're not, it's because the market's moved against me and I need to be patient and wait. I'm not going to keep putting extra risk on. So some of those early trades should have been coming off, enabling me to continue to put on trades if we're having a volatile period. But the point is, I figure out how many trades, how many SPY puts do I need to sell for X amount of money and how often to generate a certain return. So I'm getting about 4.5% to 5% from the T-bill. So I'll subtract that from the total return I'm looking for. And the remainder is the amount I need to sell premium to capture. And so you calculate how much premium do I need to sell if I'm going to capture X amount of percent. And that tells you how many SPY puts or whatever, if you want to do MES or whatever SPX derivative you want to do, you can do it based on your preference and account size, et cetera. And then you just do those trades. So basically, in mine, I'm currently putting on 1 SPY put per week for X amount of money. I'm not going to go into the great details now. And if I build up an account like I have 8 now, and if the market goes on a rip, I'm going to keep putting my, 1 per week per tranche of money that I'm looking at. And again, if the market backs up, I may have to slow down because my metrics are saying slow down. If the market rallies, all these things are going to bring money to me quicker than I'm anticipating. So I might have 5 or 6 of these come off, and I may only have 3 on, and I may have only put 2 or 3 more on, and I've got a quarter of a book. Whereas under kind of like we do here, I would just keep throwing them on and throwing them on and throwing them on. But if I keep doing that I think is what gets us in trouble when we're doing it when we feel this, we can't keep up with the theta in the account business, and we just keep randomly throwing in theta to stuff it in there to get the metrics where we need. And I'm not knocking that. It is one of the 2 ways this can be done. But when you do that, it means that you are almost, and I love other people's thoughts on this, it means you're almost inherently stuffing your account into a rally. And when the pullback comes, what you've stuffed into your account in a rally has now stopped you from adding positions in the pullback, which is really ideally when you'd be better off putting more positions on. So if that makes sense, my plan is I do X amount of SPYs per week per the plan. And so I have a timing schedule. And then I also have a percentage move schedule. So if I put a SPY put on today, and I'm not due to do one until next week, but the market falls X%, and I haven't figured out how much yet, but it's a percentage. And again, I'm doing some of these during the week. So what I enter today, I'm also entering later in the week for other parts of money in the account. The one I entered today, if we have a 3, 4, 5% pullback in a 2 or 3 day period, I'm going to be looking at adding next week's tranche. Like if I put one on today, and I'm not due to put one on until next Monday, and Wednesday CPI comes out and it's bananas and the market goes down 2%. I'm going to take next week's SPY put and put it on Wednesday, because the purpose in my mind of spacing out the trades is to take advantage of different price and volatility levels over time, as well as sell a certain amount of premium into the account on scheduled regular times so that it may come out of your account on a relatively scheduled basis, if that makes sense. So although some that we're discussing don't want to do the percentage thing, to me, I'm fine with the percentage thing because I don't mind accelerating the entry into my overall book based on price and volatility changes, even if they come in the very short term. And in fact, that enables me to accelerate these purchases into the current at a much higher VIX level as well, which is beneficial to us. So you see, I'm trying to figure out some kind of mechanical way to basically, you got me rolling because you're like, hey, if we could figure out how to tamp down our risk here. Yeah, and I think the schedule would tamp down your risk because if the market's rallying and all your theta's coming out, and you might be putting on twice as many positions as you would normally in a 2-week period, and then all of a sudden we have a pause and then a pullback, you're left with this extra baggage of relatively fresh positions you just put on. And that's when it hurts. So I'll try to stop talking, but I would love other people's input here. These are just thoughts and concepts we're working on, and I think they have validity. I already feel a lot better about my position entry, which, Bobby, you know, I have had in the past, and some of you know I don't always, you know, like it's hard. I think everyone except the most disciplined will find it hard to enter trade sometime if you're on the edge of needing to enter a trade and the market's going haywire. I find it difficult to do. The schedule tells me you have to do it. You have X number of SPY puts you have to sell every week. You have a light 111 that you need to sell every 2 weeks. And by light, I mean it's a light premium 111. I'm not even selling a 10 credit 111. These are mostly to set up a put debit spread campaign in this otherwise SPY theta generating account. It forces me to put it on. And that is also a good thing because I'm like, well, I got to do it for better or worse. The market's way up. I got to put one on. The market's way down. I got to put one on. It makes me do it. So it makes me get into the trades as I need to. But overall, I feel like it's going to help me not overstuff the account on the way up and more be likely to overstuff the account on the way down by accelerating my positions into a measurable decline. Not just a little 0.5% or 1%, no, but a multiple percent in a very short period of time where I'm putting on a whole different SPY put level or a whole different 11X level than the one I put on a day or 2 or 3 ago.
I like it. Any other comments on that?
I've been told my voice lulls people to sleep, so we may have 26 people sleeping right now.
All right, then I'll jump in. Well, that's fine. I think everything you said, but I just want to kind of say that you could accomplish pretty much the same thing if you watch your metrics and if we actually lower the maximum buying power, because I do feel that Bobby's metrics for buying power on futures are a little bit too high, especially in the low volatility. And also, if you introduce the maximum number of trades as per notional value exposure, so that this will limit you on the way up. And you could even maybe go to lower your maximum notional value as the VIX goes down or the market goes up. So that way you will not be entering trades when, like as you said, when you don't really want to be entering them, when the market is, you know, running up fast, and keep up your buying power for when it returns or reverses. But anyhow, I just wanted to mention that it could be accomplished with either with a schedule or with a little bit more strict parameters for entering the trade.
And so I appreciate these comments, Victor. To me, the scheduling is very cut and dry. I figure out the math of what I need to sell, and I figure out the schedule I need to sell it on. And I either feel comfortable with it or I don't. I like what you're saying, but in my months of experience, I have not been. It almost sounds like you're trying to come up with a filter of some kind, where a VIX filter or it could be any kind of filter. I don't even want to go through the list, but
Right, but
it
VIX
could
being
be-
an important one, yes.
It could be any kind of filter, and I'll keep track. I'll look in your room and see what's going on there. I don't know what that filter is. I mean, like just watching the metrics, and I've heard some of your commentary and I've been kind of quiet about it because my observation is I don't think we can accurately tell, oh, our metrics are between, we could go up to 35% now, but I'm going to run them at X because I don't think I want to go higher in case there's a pullback or whatever. Like that's kind of discretionary, which is fine. But I don't know how to get that clear enough for it to have functional purpose for me.
Right, but can you imagine just this? Can you just imagine if you add one more metrics to the sheet, and that one is just counting the maximum number of naked puts,
Mhm.
notional value, which really comes up to about roughly the same thing. And let's say it's 20 for your account, and then you just change it to where you say it could be even less if it's VIX, if VIX is 15, 16 or something, it's not 20, 18 or something. So regardless of all, even if the buying power is in line, if everything else is in line, but your number of puts is below the line, you don't enter the trade. So that will stop you from, and it's pretty mechanical. It's nothing discretionary about it. VIX 15, no more than 18 naked puts at a time. So what schedule you come up for yourself based on your parameters. All I'm saying is that there's no right or a single way to do it. I'm just saying that not that it couldn't be done mechanically, even the way we do it now, if you just maybe introduce a couple of extra parameters and maybe limit it a little bit more depending on your preferences. It could still be mechanical.
And again, I will watch with interest what you guys develop in your little zone and see what comes from that.
And speaking of that, Ed, if I may, just want to thank for the Bobby for the room and invite everybody if you want to stop by my room now. It's alive and any interaction is welcome.
Okay, thank you. I appreciate that. And I guess what I'm saying, and maybe I don't understand it clearly enough, Victor, but basically what you're saying, like based on me, I can put 16 puts in here. And you're saying just use your metrics. And as long as you can keep adding puts and your metrics stay relatively low, go ahead and put them on. And that is, in effect, your schedule, which is basically what we do here. Our common best practice is if your metrics say X and they're low, you add another position. And if they're low the next day, you add another position and another one and another one. That's just to keep the engine going, so to speak.
Right.
I do think that's valid. I think it's solid. But my observation is it does leave us overexposed into extended rallies. That's the real problem that seems to create. And if I'm understanding you correctly, and I'm at 8 positions and my max is 16 and my metrics are extremely low, I should just keep adding 1 per day, boom, 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 until I get to my 16 and then stop no matter what, because that's my max. And if my metrics are still low, I just float along and wait for some positions to burn off before I can put new ones on. And if my metrics back up, well, I've got a full load and I'll deal with it. Is that kind of summarizing what you're saying here?
Well, roughly, probably, but what I'm saying is your metrics are flexible, and if you spend some time, you can make it so you can restrict yourself in any way you like. So you could introduce those restrictions the way you like it to stop yourself. But yeah, you're right. You're even more limited or even more structured if you go by the way you were saying. Absolutely, that is more structured. But I'm just offering an alternative to maybe. My main point is I personally, I have an additional column there for my notional value, and that keeps me, even if all the metrics look good, I know I'm overexposed if I go over a certain amount of things, and then I need to either close something, and I may have to wait until, you know, that trade is at a profit that I need, and that will keep me from adding trades just as on an ongoing basis. And also lowering especially in the low risk environment, lowering further the maximum buying power and other metrics. Yeah,
Mhm.
or be a schedule as you know, as a weekly or any other type of time schedule. That's correct.
Mhm. Okay. Well, I think we'll both just plod forward and see what happens. And, you know, there may be a consensus of one or the other, and there may be some kind of merger. Like I've taken my schedule thing and I overlay volatility onto it. I permission myself to accelerate my schedule into a measurable plunge. So, which may or may not be for the best. I could load up into a plunge and it keeps plunging more. Well, at least I didn't load it all up in 2 days. It took me a week and a half to load it up. You know what I'm, or you know, it just spreads out my ability to, it's going to slow the whole thing down. It slows down continued profitability in a rally because you're not stuffing in max positions just to keep your theta up. And it should allow you to layer in positions on the other side.
Yeah, and to your point, I absolutely agree. For example, I could introduce another column for myself where I put some time delay, like a maximum per week or something. You know, there is no black and white. You could add
Right.
certain things to this, or I can add certain things to this. So yeah, to slice the turkey here.
Yeah. Well, I appreciate the interaction, Victor. I mean, like, again, we're all on the same path. We're just on different spots of that we might even be standing next to each other, but we're standing in different spots as far as our preference for how we're managing the accounts. I'm not etched in stone. I'm just trying to figure out the most mechanical way to enter a tranche and manage it all the way to the tail end. And that includes defense. That includes, you know, not subjecting the campaign to overstuffing at the wrong points, so that I'm not stressed on adding positions when I should be. Because one of my accounts was very stretched. I went very public on that, my IRA, where I was doing these LTs, and I found out you really shouldn't be doing an LT in an IRA account. I'm like, okay, found that out. Because it got way too scary. My other account was down, but it really wasn't down much. And if I didn't have the turmoil of the IRA, and if I had had a schedule, I would have been adding positions into that account. But because the IRA was driving me nuts, and because I'm like, yeah, I got enough data, I'm going to wait and see what happens in this situation, I didn't keep adding into the pullback in the other account where I actually had the ability to do so. So here's another confession for everyone to listen to and learn. So I'm trying to make things more mechanical so that if I get in a similar situation like that, I will, if I have different accounts and I'm trading them in different ways, I need to trade each account according to the plan that I have for that account. And what I found in this Volmageddon thing was my littler account, which was in high stress, distracted me from my bigger account and got me off track of what I should have been doing. Do I have regrets? No, I do not have regrets. I'm pulling 0.75% out of this account a month. So far, I've done it in all 5 months, and I'm still up a fraction of a percent. I'm not hitting my goal. My goal is 12% to 15%. I'm not doing that right now. I'm probably closer to 10 right now. I'm not going to complain about that. I'm not. So, because as long as I can do my 3/4 withdrawal and have some extra change in there, that's my ultimate bottom line. But I can tell that I'm flirting with not being able to make that because I'm not really loading the account up with the optimal amount of theta. And it's because of these things. It's because I had outsized returns early on that turned into outsized losses. And that distracted me from my big picture. So I'm just taking that whole experience and trying to look at it, examine it, tweak on it, and spit it out on the other end so I don't have to have that same situation happen again. And that's where the scheduling, it was already ringing in my head and it rang way louder. And then the day I was leaving to go on vacation, I jumped in and because Ryan was, I think it was either his graduation or he was giving us his metrics. And I forgot what else is going on, but that was the first time that I kind of threw out there the scheduling business, which again, Raging Bull and I had already been looking at that point. And I saw as something valid. So I'm not saying everyone should run out and do this. There are two ways to managing this. One is, quote, by the metrics, period, unquote, where you look at your account. It's kind of like what we do here every day. Bobby looks at his accounts. He decides if he's comfortable with his risk. He decides if there's enough theta in the account. He either puts on positions or does whatever he does. And that's the same thing we're all doing. And then of course, some of us are trading 1-1X. Some of us are trading Strangle. Some of us are doing Iron Condor. Some of us are doing a combo. Some of us are doing one product. Some of us are doing multiple products. There's all kind of things going on here. So it's very hard to generalize for everyone what the best thing to do is. So I kind of slice it into two categories. One, the scheduled category, and two, the discretionary entry and strategy, where you are discretionarily adding positions, and we can come up with rules on when we're going to add, like Bobby's metrics say, here's my metrics. I need to add. That's not discretionary, that's mechanical. But then the next day it might be, well, I'm comfortable with my risk. I'm a little, there is some discretionary mixed in with the mechanical, but ultimately the metrics send out a loud, clear message to Bobby, to me, to you, and to all of us. And when the metrics whisper or scream their message, Bobby may hear a different message than I hear, because Bobby is inherently more of a risk taker than I am. But I don't want to be handcuffing myself to not do the long-term thing because of a short-term issue. And that's what I found myself, not just in this Volmageddon, but other periods. Sometimes my metrics say don't add, but sometimes they say, yeah, you're not that high, you could throw some on. And I know that is the time where we make our oversized profits. When we have buying power left and we can put on additional risk in the high vol period, that's where we create the alpha. That's where we create the bonus money for ourselves, I think. So I don't want to penalize myself. I have to be more mechanical. So I'm working to be more mechanical. Bobby may continue going just like he is, where he's very mechanical on watching his metrics and somewhat consistent, I think, on interpreting those. And Victor, you're kind of like almost somewhere in between, like you're working it with the metrics, but you're trying to come out with some little fine tuners where, let me fine tune this thing to keep myself out of trouble and let myself take advantage of opportunity.
Exactly.
And again, no criticism there. It's again, we may be having this conversation in 2 months where we say, hey, Victor, yeah. And now and then we're both saying the same thing. I don't know. But I just want to throw that out there because I think it's what we need to keep in mind. There's the pure schedule, the pure mechanical as much as possible, following the metrics. And then there's the more subjective, discretionary way of following the metrics and managing our account. And Victor, you're somewhere kind of like in between there, which
well,
is interesting.
Just to be clear, I really want to do it as mechanical as possible. And if I can get it to 100% mechanical, that's what I'm going for. Now, I'm not sure if I'm ever going to get there, but that's my goal. So 100% mechanical, or as close to it as possible. But it's constant fine tuning like everybody else. We're constantly, learning something, hearing something, trying something, and then adjust it and change it a little bit here and there. So
Yeah.
Any input is valid.
Well, we're definitely on the same spot on that. So all good.
Okay, great discussion, y'all. Hope you have a wonderful day, and I will see everybody tomorrow.